Hello and welcome. We are Markstrat from Technos. Technos is composed of team members Jabu Dube, Michelle Fay, and Anand Xavier and Tyson Reed. We'll jump right into our slides. The firm operated for 8 periods. Through those 8 periods, we produced a total of 4 sonites: tone, toe, top, and torn. Looking at the firm, brand, and segment performance, starting off, we had tone and top were our two products we started with. Tone was our strong and steady performer and kept our company out of the red on a regular basis. And top, it seemed to hold us back until we were through the brand in period 7. Torn was a brand we launched to try and capture more market share in the saver segment. We were not able to get that going with the already saturated market of products established in the savers market. Toe was a product that we added in period 5 to meet the needs of the shoppers market. We started off with a 2% market share right out of the gate, and we increased that to 6% the next period. Toe continued to grow and capture more market shares as we increased and focused on advertising and distribution for that product. Next, for our overall performance, as you can see from the graph, we started strong in the first couple of periods, but then felt the devastating effects from other teams launching new products which better fit the needs of their respective consumer segments. We had a difficult time rebounding from this loss, even as we tried to modify current products and launch new products. Looking at the graph, the SPI and the earnings show a trend that starts off strong, drastically decreases, so it starts to increase over the last 2 periods, most likely from the massive increase of revenue that we invested in advertising and distribution for our products Tone and Toe. The revenue shows a similar trend in that it started off strong and decreased. However, it maintained a steady balance through the remainder of the period thanks to our consistent performance of Tone, our strongest product. The next slide shows our individual brand performance based on consumer segment, and as depicted in the graph, Tone being our strongest brand of the large segment of the professional market after we reallocated our resources to focus directly on that individual market. Toe was very successful in the shoppers market. We focused 100% on that. And Tops and Torn, they were both discontinued, but the data shown here was from their last period for each one. However, if you look at the pictures, you can tell the market share was pretty small, and both of those segments were costing our company money, which is why we decided to discontinue those. So next, we'll look at our segmentation from Anand.
Thanks, Tyson. So we quickly understood that the consumer needs in each consumer segment were significantly different. During the various periods in the simulation, the brands that top the consumer segments confirmed that the correct consumer segment selection is important for the SPI gain. It was also to focus and increase market share in consumer segments where the brand can produce maximum sales with high purchase intentions. During the early periods, the product offering from our team, which was Tops and Tone, seemed to meet the consumer needs in the explorers and high-earners market. But in the later periods, it was clear that the brands focusing on growing segments had a needed growth curve due to high purchase intentions and continuous increase in the overall market volume. In order to attain higher market share, we employed brand repositioning and more product offerings by changing Tone to professionals, Tops to high earners, and created new products for savers and shopper segment. But the Tone and the Toe, even though they performed very well, it wasn't true for the new products. However, we learned quickly that we can't focus and provide brands for all consumers due to other brands being aligned into some of the segments. The team also learned that advertising is equally key in obtaining the right market trend and maximizing sales, as shown in Tone, which has the highest brand awareness with the highest market share. Next, we look at the product characteristics and how they impact the market. We identified that during period 3, developing products that meet target market product characteristics is needed for being successful. During the early periods, even though our Tops and Tone brand was pretty successful due to the brand being closely identified to the target segment. During later periods, The brands was performing relatively low due to the segment characteristic changes, which you can see the revenue being dropping down from that. The alignment of the product characteristics to segment perceptions and projecting brand ideal characteristics was identified to be key for the best marketing strategy. During period 5, we repositioned upon the successful modification of brand characteristics to the ideal values. The impact of the alignment of the segment forecasted characteristics was immediately evident with increase in revenue in period 5, especially the tone brand, which showed a major impact of the product lifecycle management that leading the segment immediately upon repositioning. Next, we will see the impact of price. Each consumer segment was identified to have different perspectives related to the pricing of the brands. Based on market research studies, we learned quickly that the price of the brand is also key in targeting the segment. The brand characteristics of pricing was identified as a key factor for the bottom line to make the contribution margin and maximize sales. During period 1, it was identified that tone and tops brand pricing was close to ideals, seen in the semantic scales, which saw an immediate impact for our overall company. The team also understood that sudden changes in pricing would impact purchase intentions, which is shown from the changes from period 1 to period 2, when the tone brand, for example, saw a change in the middle periods due to the heavy changes in pricing. We quickly learned that trying to scheme the market with low cost causes more hurt and impacts the brand alignment when we try to launch new products in other segments. So in period 5, as you can see, the actual new products did not do very well due to that. The tops brand saw improvements with the strategy, but it was so short-lived. The success to the tone brand was with maximum revenue and purchase intentions clearly showed that the bottom line of base cost to submit price needs to have the correct ratio to impact contribution margin. The success in total brand clearly showed that the price to volume was a key contributor in consumer segments, so the ratio cannot be high. Even though the purchase intentions changed for the top brand, the overall contribution was identified to the negative, which caused the brand to be dropped in a later stage. Next, we'll look at the place by Jabu.
In placement, we initially targeted multiple segments with one product. We had our first product that we started was a tone and top, trying to target a couple of segments at a time, and we realized that this strategy didn't work. So as we went on, we actually developed our strategy to target individual segments with one product. This actually assisted us in planning our commercial team and using them efficiently and putting them in the right position in order to be successful. We used we had the segment shopped in 3 different locations: maximum merchandise, online sales, and specialty stores. And we used, we studied the buying patterns, and this actually assisted us in choosing where we should allocate the commercial teams. By period 8, we were allocating mostly in the specialty stores because our most successful product, tone, was focused on high earners, and they were mostly in those specialty stores, and we did very well using this strategy. We could have developed it a little more, but I think we learned a lot, and as we went along, and the strategy didn't work for us. We move on to promotion. In promotion, we focused a lot. Promotion was key to maintaining brand awareness in our products and actually maintaining our market share. We developed a strategy of investing heavily in advertising throughout the 8 periods. When we brought in extra products to compete with our competitors, we found that we had less money allocated to advertising. This actually affected their brand awareness, and that's the decision. That's why we took the decision to actually discontinue tops and tone. In the products where we did allocate efficiently tone and toe, we saw consistent high performance in brand awareness. The tone was always at about 54% in the segment. And we also sold as well, did very well in being a new product. So we did learn that advertising is very key to success in this industry. And so we'll go on to Michelle, who will go on to keys to success.
One of our major keys to success was to concentrate on contribution margins. And just like in the real world, there were several situations where resources were tight and we had to choose one product line to focus on over another. When that was the case, we chose to focus on products with the highest contribution margins in order to increase our overall profitability. Another key to success was basing many of our decisions on not only the present market conditions, but the future as well. Based on the market forecast, we were able to see the market was expected to grow each period. However, the market size growth varied tremendously between segments. In period 0, we didn't have any products that fit into savers or shoppers segments. And since these two segments were predicted to grow the most, we took a loan to perform R&D and develop products that would fit. On to lessons learned. Even though Technos performed well overall, there were still several lessons learned and things we would do differently if we could go back. The overarching theme is that we should have employed a better long-term strategy, first making hindsight decisions each period. While we did look at the future of the market segments, we should have better tried to anticipate the future of our competitors. This would have allowed us to predict their actions early and adjust our own strategy accordingly. For R&D, looking back, we know we should have performed R&D sooner. Each round, we concentrated on raising our advertising, leaving very little to R&D. By the time we decided to start research and development to launch new products, we already saw competitors slipping away with several more product lines. In essence, we didn't react quickly enough, and we should have taken the loan sooner to launch new products sooner. Research and development also takes time to complete, one period to complete and one period to launch. If we had the opportunity to go back, we would have planned our R&D product characteristics better so they weren't outdated as soon as they were launched. This was the primary reason we were never able to get our new products to be as successful as we had hoped. And since they weren't as successful as we had hoped, we weren't able to raise enough funds to continually improve them with further R&D. In regards to advertising, the primary objective of advertising is to build awareness for brand names and make consumers familiar with the product characteristics. And it's a key way to gain market share, especially for new products. If we could go back, we would use multidimensional scaling earlier to analyze consumer perceptions and allocate our advertising budgets better. We would keep advertising media high for current top performers. Product placement, as discussed earlier, several times we spent the majority of our budget on advertising, leaving little room for R&D. We see now that had we kept up with R&D to better place our products, it may have required less advertising. Segment concentration. As we discussed earlier, we originally tried to over-diversify our portfolio by marketing our products in 2 different segments, each which ultimately didn't allow us to take the lead in either segment because there were not enough resources. We could go back, we would focus each product on only one segment, allowing us to better place each product and appeal to that certain industry. Production. Many of the big costs that could have been avoided for us revolved around production. We should have been better at predicting production by using just-in-time manufacturing to predict demand but avoid surplus. This would have eliminated large carrying costs from extra inventory after R&D launches, and exceptional costs from obsolete inventories that were sold to trading companies once withdrawn from the market. In regards to commercial team, if we could go back, we would better analyze our competitors' commercial team allocations to predict the more ideal balance for our commercial team allocation in order to increase purchase intentions and decrease the impact of competitors. That concludes Team Technos' presentation on our experience in Markstrat within the London industry. We hope you have learned a lot and have a better understanding of the impact of marketing on the production and selling of products in both the Markstrat world and the real world.